Y'all seen the market lately? Yikes. The market's down, like down bad. The S&P 500 is down almost 7% in the last month, and some tech stocks are down almost 50%. So what should you do during a market downturn? I'm here to give you a couple things to help you navigate these interesting times and make sure that your investments and your goals continue to progress even when the market's not doing the best. Oh, that's a bar. Number one, don't panic sell. The last thing you want to do is panic sell. I personally, throughout my young life, have panic sold many things, cryptos, stocks, even cars, thinking the market was going a different direction, only to lose value and be upset about it in the future or buy back higher. Ultimately, you should have timelines and a long-term time horizon for most things you invest in. When the market drops, you should be confident in what you've invested in, meaning that when people are panicking and selling, you should be potentially buying more and lowering your cost average for that position. Anything like the S&P 500 and long-term holds, they're great to continue to stack. Do not stop contributing to your 401k or your retirement accounts. These are usually matched at 4 to 6% by your employer, and this is just straight up free money that you'd be walking away from by not contributing. You'd still be buying these equities and stocks at lower rates, and again, lowering your cost average for each stock and increasing your long-term growth and share count. So it's really not smart to stop contributing to your 401k because the market's dipping. These are the best times to be buying and the best times to be contributing. It's also key to understand why you're investing and what you're investing for. What are your long-term goals? Are you investing for growth? Are you trying to grow your investment account as big as you can in the next 20 years? Are you investing for income? Are you trying to buy the most stable dividend stocks or dividend equities such as SCHD and VTI? These are important things to note and understand when the market is down because it affects what you buy, what you sell, and how you rebalance. Ultimately, if your portfolio is full of stocks you plan to hold long term, again, these downturns shouldn't faze you. You should be continuing to buy, continuing to dollar cost average, and continuing to lower your cost basis for the long term. The next thing you want to do is buy the dip. Think of this downturn as a sale for all your favorite stocks, indexes, and any investments you'd like to make. When investments get cheaper, you can lower your long-term cost, and your upside and your percentage of gain over the long term will grow exponentially. For example, if you like Tesla or if you like Nvidia, these stocks have been up only for the past year. They're currently experiencing some down pressure and some down times. If you believe long term that these stocks are going to do well, it's a great time to buy them. Bitcoin had ran all the way up to $108,000. It's currently sitting around $84,000. This is a great time to buy Bitcoin if you think in 10 years, in 5 years, it's going to be more expensive or Bitcoin is going to be worth more than it is today. The 10 best days in the stock market come right after a downturn. So to be not invested and have sold your positions is the worst place to be. I know you love to see sales at Nike. I know you love to see sales at Sephora. And when you see those sales, you say, oh, I got to go cop that. I got to go grab that. You should be thinking the same thing about the stock market. If your favorite stock is down 15% and you think they're going to do great in the next 10 years, you should be buying that. If the S&P 500 is down 10%, but you've known that it's gone up pretty much consistently at 7% every single year, plus or minus some random years, you should be buying that. So when down markets come, you should look at this as an opportunity. When people are fearful, you should be vigilant because this is the time when things are undervalued. This is the time when people make the highest percentage gains. And again, right after downturns is when the market has seen its best days in history. So keep that in mind. Remember, not all stocks are created equally. You don't want to hold something like Rivian to the bottom when you'd rather hold a long-term staple stock that's been around for 50 to 100 years, consistently paying a dividend. And that brings me to the final point. Make sure you're diversified. You should have a broad, diverse portfolio of different kinds of stocks, commodities, telecommunications companies, technology companies, staple consumer product companies, retail companies. Your stock portfolio should have a basket of different stocks so that when one industry or one sector takes a hit, you'll have another one making up for it, holding up your portfolio. And if you don't want to pick individual stocks, if you don't want to go through, read company financials, read income statements, and anything related to that, buy index funds. Simply dollar cost average into the S&P 500, which over the past 30 years has averaged a 7% return, and you'll be set. Also in your portfolio, you're going to want to have other types of assets like real estate, gold, crypto, whatever other asset class you're most comfortable with, make sure you have some in your portfolio. For example, if stocks are down 40%, real estate's likely to only be down maybe 5%. And if real estate's down, likely gold is up. Make sure you have that diversification in your portfolio and you'll be hedged. My favorite investment method is to dollar cost average. I simply set it and forget it. I set a certain amount to come out of my paycheck every 2 weeks or every week, and that gets invested into a certain basket of stocks every single week, consistently. I personally use M1 Finance. I'll drop my link below to the profile and an affiliate link where you can get some free stocks. It lets you create a wheel in a basket of stocks. When you submit your recurring investment, it will manually diversify that investment based on the percentages you've selected for each equity. This is nice because you don't have to go in and buy each individual stock on your own. $10 here, $500 here, $50 here. You can set these percentages up, set your recurring investments, and set it and forget it. Not even have to think about it. And just keep in mind, there's never a right time to invest. When the market's going up, people are going to think things are too expensive. When the market's going down, people are going to think it has way much farther to fall. So the best thing you can do is create your plan, create your long-term investing goals, and invest accordingly. In the upcoming video, I'm actually planning on sharing my portfolio, sharing some of my investment thesi? I don't know. Sharing how I'm investing and getting some feedback and advice from all of you so we can invest together, grow together, and learn from each other. There's also a lot of speculation that the Trump administration may be forcing the economy to slow down to get interest rates to go lower. They're doing this so they can refinance the national debt. There's something like $10 trillion of national debt that's maturing this year, and they don't want to refinance it at these high-ass rates. With that in mind, I don't think they're dropping this market for it to stay for a long time. I think it's a great buying opportunity. I'm taking advantage of it, and I hope you are too. When the market shifts, it's also a great time to rebalance your portfolio. Maybe it's time to sell off some of those tech stocks you're up a lot on. Maybe it's a great time to get out of some down stocks that just haven't moved for a while and move them into some more long-term plays that you're confident in. Again, I always suggest that if you don't want to check stocks and always have to track company performance, just invest into the S&P 500 and dollar cost average, set it and forget it. Let's take a look at a chart to see how the stock market has performed in previous downturns. As you can see, the market has always bounced back from recessions, even the really bad ones. This should give you some confidence that the current downturn is likely to be temporary. However, it's important to note that the time it takes for the market to recover can vary significantly. For example, the market recovered from COVID in just 4 months, while it took over 12 years to recover from the dot-com bubble. It's also worth remembering that the market doesn't always go up. We've seen periods of flat or even declining markets last for years. This is why it's so important to have a good long-term perspective and a diversified portfolio. So to sum it up, don't panic, understand your risk tolerance, buy the dip, but be selective with it. Stay diversified, dollar cost average, look for opportunities when you can, and rebalance your portfolio. Thanks for watching. If you enjoyed this video, please give this video a thumbs up, like, subscribe, and look forward to the next one. I'm excited to continue growing with all of you and growing my channel. Please leave a comment on the topic you'd like to hear more about. I'll see you in the next video. Peace.